So, Treasury Secretary Scott Bessent potentially as the replacement for Jerome Powell after his term is over as chairman of the Federal Reserve. That's one of the things we'll talk about today. We'll also talk a little bit about consumers spending, Walmart, Lululemon, and Deckers. Today with my friend, colleague, and chief strategist at OptionsPlay, Tony Zhang. Today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, and welcome, of course, to Tony Zhang, who is joining us from around the world. Where are you today, Tony? Where are you living these days?
Mike, I'm in Melbourne, Australia at the moment. Thank you so much for having me. It's fantastic to be on your show.
Yeah, it's great having you. One of Holly's very good friends when we lived in Austin was from Melbourne. It sounds like a lovely place. I know your wife's family is from there, so thank you for joining us at this obscene hour for you. You know, it's easy for us, but not for you, so we're very happy that you're able to join us. So, yeah, let's just talk a little bit first at a high level about some of the things that are going on right now. We got today's inflation data. The inflation data came in, I guess we would say, better than expected, much better than the survey numbers. And then, of course, I thought it was rather interesting. Paul Tudor Jones was among those, but it's being very broadly discussed. This idea that Scott Bessent might be the replacement for Jerome Powell as chairman of the Federal Reserve. I'm not one of these people that happens to think that Powell will be leaving his post before his term is over, but I think his term is due to expire in 2026. Is that right?
Yes, I believe so. Yeah. That's correct.
And what they're talking about is Scott Bessent potentially replacing him, which I think is kind of interesting. Number one, Scott Bessent is not a lightweight in this area. The second thing is because of his prior role as the U.S. Treasury Secretary, you know, I'm wondering whether that's going to impact at all how he sees the world in terms of monetary policy. What are your thoughts on that?
Yeah, absolutely. I mean, right now, I actually think monetary policy is a huge issue right now. We've seen, and I'm very curious to see how the 30-year bond auction goes tomorrow, because right now, I actually think treasuries and focusing on the bond market is really where I have a lot of my attention on right now with regards to macroeconomic picture, because overall, the economic picture in terms of the hard data has actually been relatively decent, right? Inflation is ticking in the right direction. Job numbers so far remaining relatively resilient, even though we had that revision for the prior 2 months that came in a little bit softer. But May was a fairly strong jobs report. And even some of the sentiment data is starting to see a little bit of an uptick, after what has been a few months of declines. So right now, I think the big concern that I think market participants are not as worried about right now, that they should be more worried about, is really the amount of debt that we continue to pile on and anticipate will continue to pile on for the next few years. So, the softer bond auction we saw a couple of weeks ago, that was a bit of a blip on the volatility radar. I think that's going to be a bigger issue. We also had Jamie Dimon warn us about this, right? He warned about quote unquote cracks in the bond market. And you're going to see those cracks in softness in kind of the longer dated bond auctions first. And, we have a 30-year coming out tomorrow. We have a 20-year, I think, on Monday. We have another one at the beginning of July. And I think these are really important events for investors to pay attention to. These bond auctions typically are not on most kind of macroeconomic data release radars. But I think nowadays that's going to have a bigger weight going forward.
Yeah, I agree with you. I think that the issue of the bond vigilantes is something that equity investors are paying a lot more attention to, and rightly so. Look, we had a 40-year bull market for bonds. So just ever declining interest rates, culminating with effectively zero and in some cases negative rates post GFC. So one of the things I think that's kind of interesting is that if we do see soft inflation data, and there is some potential justification for lowering rates, the Fed funds rate is really going to have its largest impact on the short end of the curve, right? So it's, one of the things that I think is kind of interesting here is that, I was highly critical of, and I've remained highly critical of, the Biden administration and Janet Yellen's decision to finance a lot of the government activities at the short end. But if the yield curve steepens significantly and the front end comes down, then to mitigate, essentially to mitigate interest expense, it probably is likely that the government would start issuing a little bit more in the middle and short end of the curve to try to take advantage of the lower interest rates. And I think there's probably going to be more liquidity there, so that's not going to have much of an impact on the auctions that you mentioned. But do you think that that would potentially at least stabilize the bond market a little bit if we started to see some steepening and more sort of issuance, we'll call it inside of 10 years?
Yeah, absolutely. I definitely think that, we need a combination of a few different things, right? And I think if we do see, as you say, a steepening yield curve and that the shorter end of the curve comes in, that's definitely one of the tools that the Treasury Department has in order to try to bring down borrowing costs. But at the moment, borrowing costs across the curve is continuing to move higher here. And that's really kind of the big concern, I think, for a lot of bond investors right now. And I think equity investors really need to be paying attention to that as well. Scott Bessent, I think, is potentially well suited for this particular role. I think I just looked it up real quick. May 2026 is when Jerome Powell's seat is up. So I actually think he's a pretty good candidate for that specific role.
Yeah. One thing, of course, that I would also mention about rates is that rates have big impacts on other borrowers, not just the government. We think of the government first because they're the largest borrower, but it also impacts the cost of capital for private industry and for individuals like consumers. So durable goods, things like this. And, I was asking you your thoughts on a couple consumer names, not so much in the durable goods space, but, names that we sometimes think of as consumer, sometimes staples, sometimes discretionary, depending on because we got some earnings results out of Deckers, which I thought was interesting, Lulu, which I think is interesting. But you were mentioning Walmart just before we went live today. And so I was wondering what your thoughts on Walmart were, because it's getting to an interesting spot here.
Yeah. Walmart recently made an attempt to break out above $100 back in, call it February. That failed. And it's made multiple attempts to break out above $100 in just the last couple of months, and just was rejected again at those levels just let's call it a week ago. From my perspective, Walmart has been doing a lot of great stuff from a business perspective, right? Their e-commerce business recently just turned profitable, which is commendable. They're competing potentially against Amazon and Amazon Prime from that perspective. They're doing just overall seemingly executing well on their digital strategy here. But there's clearly signs of exhaustion here. If you look at the chart here, as you kind of make those higher highs and try to break out above that $100 level, there are signs that there's some level of exhaustion here from buyers. But more importantly, I think the story here is the fact that valuations for Walmart just look quite ridiculous in terms of how stretched they are. We're trading at 37 times forward earnings. And people have to remember, these types of big box retailers, grocery type stores, they operate on razor thin margins. Walmart's net margins are 2.75%. So it's really difficult to justify trading at those types of rich valuations. When you're heading into an environment that is arguably quite uncertain for these types of companies that source, the vast majority of their goods out of China. How their ability to potentially pass on any potential increases in prices onto the consumer given an environment where consumers are already quite what's the right word, selective with their spending, right? As we saw Lululemon, you saw Chewy, you saw Deckers. This is all showing us that consumers are being a lot more selective here. So the fact that you're trading at such rich valuations with such thin margins, I just think we're heading into an environment that's not particularly favorable for those types of metrics. And you could argue, like look at stocks like Costco. They trade at 45, 50 times forward earnings all day long. And they consistently do that. And I can see a reason for that. But if you look at kind of not only on a earnings basis, if you look at it from a price to sales basis as well, both Costco and Walmart are trading at some of the richest valuations they're seeing on both, price to forward earnings or price to sales. And I think you're just getting to valuations that I think are quite difficult to support in this type of market environment.
Yeah, I think that's an interesting point. I mean, what I think is even more interesting, I mean, first of all, Costco and Walmart, a defense for them. Yeah, I mean, both of these businesses, a justification for them that I can see is that, I mean, Costco is a grocery store by and large. Their general merchandise revenues are relatively small as a percentage of their total sales. And what isn't grocery revenues comes in the form of subscription fees, which is a very nice and very high margin business to have, right? So people are just paying you a regular fee just to be a member of your club, so to speak. But as you rightly point out, the valuations are getting quite extended relative even to their own histories. So as you pointed out, Costco has often traded at a multiple that was higher than that of the broad market. Actually, I'm just going to compare the two right here. So, we've got the SPX down here and we've got Costco up here. We go back 15 years or so, and Costco was trading, in this range over here around 21.5 times earnings back when the market was trading between 16 and 18 times. So it was trading at a premium, but the premium has definitely gotten a lot larger because now we're trading at around 23.5 times forward on the S&P, and Costco's trading up around, it's north of 52 times forward. So I'm just going to draw a line over here so people can see where we're at. This goes all the way, we're looking at 40 years worth of history here. Now, it was interesting because before we went live, I was just talking to Tony about it, and I mentioned, well, Walmart actually has traded at a higher premium than it does right now, but it's probably not going to be that consoling to those who are saying, see, it's traded higher, when you realize when that was. And that was actually during the tech bubble in 99 and 2000. So we obviously had a stock market bubble. And Walmart was much more of a growth story back then. We're now trading not far below 40 times forward for Walmart, depending on whose numbers you're looking at. It's a pretty extraordinary valuation for a grocery store, a very well-operated grocery store, the world's largest grocery store. There's plenty of things, and you could also say it seems like some of the tariff headwinds are backing off just a little bit because according to my former boss, Howard Lutnick, it seems like the United States and China are finally, getting very close to a final deal if they haven't arrived at one already. But I'm kind of in agreement with you here. Compare and contrast that with names that we have typically seen, like Deckers, which you mentioned. And here we're looking at Deckers. I should get rid of this annotation because it's not even relevant. Just delete this. So here we're going back as far as we can, and we can see we're basically right back to probably a mean valuation and a discount to the market. And this is because this was a real growth story that arguably is not viewed to be such a growth story anymore. But these are the guys that have Hoka shoes, for example. They have Uggs. And, the earnings were actually not all that bad. If you compare it, if we take a look at the top line, we're still looking at year-on-year estimated revenue growth of just shy of 8%. And, down here, this was really the issue, which is you see a little bit of stagnation on the EPS side, a little bit of margin compression and things like that. But what that means, of course, is that you're not, you still have room to get some margin expansion back to 26. We're still looking at 8% top line growth estimates for the subsequent fiscal year. And, you go out a couple of years and it looks like people are sort of saying, even at these lower margin numbers, we've lost about 200 basis points off of the net income margins. This one seems kind of reasonable to me at these levels, at least maybe selling some puts. What do you think?
Yeah, I mean, I follow Lululemon far more than I do Deckers, but I mean, Lululemon kind of getting knocked back down to 17 times forward earnings. I like Lululemon all day long at 17 times forward earnings, whether you want to sell puts or sell put spreads. I think, those are great opportunities. Lululemon was starting to get a little bit stretched prior to that earnings announcement, even though I still think that, when it was trading around 22, 23 times forward earnings prior to the earnings announcement last week, I thought that was still reasonable, right? Lululemon net margins are north of 16, 17%, which is substantially higher than the industry median or industry average. But coming back down to 17 times forward earnings, I'm a big fan of Lululemon because of the strong net margins that Lulu continues to command. And just to kind of put things into perspective, right? Walmart trading at 37 times forward earnings. We're expecting top and bottom line growth of low single digits, right? Net margins that are roughly around 2-3%. Look at Nvidia. Nvidia is trading at 33 times forward earnings, right? Which one would you prefer to be a buyer of between those two?
52% net income margins after taxes and growing at double digits. Yeah, I think that's a pretty easy one. And in the midst of all of that, right about the time that everybody says, oh, are all of the big spenders in AI going to curb spending? That's always the big thing. Is CapEx going to drop? Are they going to stop investing in the space? And then Mark Zuckerberg says, oh, we want a super AI unit to come out, and we're going to offer 9-figure salaries to our top hires, to lure people away from other places. Well, I wouldn't worry too much about GPU sales when people are ready to pay $100 million plus to a guy who's an expert in the space. It's clear that the investment's far, far from over. Let's take a quick peek here. And since you were looking at Lulu, what do you think? Selling puts, put spreads? What's your favorite strategy here for Lulu at this point?
So it depends, I think, for the viewer, right? Because I think Lululemon is still on the expensive side from a stock. So selling puts, requires a hefty amount of either margin or cash to do so. So, if you do have the capital to sell puts, I'm a big fan of selling puts right now on stocks like Lululemon. Let me just take a look at this. We're trading just around that 258 level here. I usually like to go out about 30 days and I usually sell about a 40 delta, which comes in somewhere between the 250, 245s. They probably go out to maybe the 245s that on the July 11th, which are about 30 days out. That's a weekly expiration. You can collect about $6, a little over $6 to sell that July 11th 245 puts. So those are puts that are basically, call it $7-8 out of the money. And it'll basically, if you do end up getting put that stock, you'll own the stock around 238, which was the lows from call it April 3rd, April 4th. You would be able to own it at those prices. And just to kind of put those in yield terms, you'd be collecting about 2.5% of the stock's value in 30 days. That is a nice chunk of yield that you're collecting on a stock like this, even after earnings. And being able to pick this up at around, but if you do pick it up around 238, you're probably picking around 16 and a half times forward earnings at that point. And I think that, corresponds with both a strong valuation to own the stock at, and also from a technical perspective, that's a pretty strong support level that we've seen here over the past couple of years around that 240 level, going back multiple years.
And if you're put the stock, you would probably just go into a wheel strategy or something like that and just sort of work selling some upside calls against it. What delta calls would you look to sell? Also, similarly, I assume 30 days or so to expiration is what you would probably use in that case?
Yeah, for cover calls, I sometimes, I can go out a little bit longer to about 45 days out just because, cover calls, you tend to sell or the idea of selling cover calls is you want to do it over and over again. And you want to do it as a mechanical strategy. So 45 days out, at least for me, I find is manageable so that I don't have too many cover calls being rolled every single week. I don't particularly like selling short dated cover calls for that reason. So I usually go at about 45 days. And what with cover calls, the thought process and when you're thinking about strike prices is a little different than selling puts. Because when you're selling puts, you're trying to collect, a good amount of yield. You're trying to also have a strike price that you have a relatively high probability of ending up being put that particular stock. So when I'm selling puts, I use a higher delta, closer to around 40 deltas for puts. But when you're selling calls, it's a little different, right? Because you now own the stock, you have the overall risk that you have is tied to owning that particular stock. And in order to justify taking on that risk, you need to be compensated with enough upside appreciation in order to hold on to that stock. So when I'm selling calls, I go much further out of the money. I usually go at around 10 to 15 deltas. So for example, if I'm going out 45 days out, that's at the July 25th weekly expiration. So I'll probably do the July monthlies in this particular case because that's pretty close to 45 days. And then if I'm selling cover calls, I would go out to roughly the call it the around the 290s in this particular case.
Yep. I realized I had already switched to Deckers, but I'm just gonna throw it back to this. So if we're just gonna take a look. So if you already own the stock and you're thinking about selling some covered calls, you're thinking
the July 290s.
Delta wise, yeah, 290s. Those are a 13 delta. That's what OptionsPlay has them at right now. So you'd end up in a strategy a bit like this.
Yeah. So you'll collect you'll collect the $1.80, which comes out to around 7% annualized yield. On a stock that pays no dividends, I'll take an extra 7% a year, selling upside calls, while I'm still maintaining a significant amount of upside appreciation, meaning the stock has to rally a significant amount in the next 45 days before this gets called away. I'd be pretty happy if the stock rallied to 290 in 45 days or 37 days rather.
Yeah, I agree with you wholeheartedly. One of the reasons is that, and we've talked about this before, you don't buy a stock simply because you think it's fair valued. If you think it's fairly valued, then you might as well probably just buy an index, right? To buy something like SPY. On the other hand, if you think that you're getting it cheap, why then would you turn around and sell the stock 2.5% higher or 3% higher? You want to give yourself a little bit of room. Like you pointed out, you're getting the thing at 16.5 times forward. If it goes up 10%, then at least you're getting another 1.7 turns on earnings out of it. And you're really trying to reduce the likelihood that you're going to be called out of the stock. So we have a couple questions here, and I'm going to start taking these things in order. So PC got in here and actually asked a question even before you joined us, but it was directed to you. So Tony, in OptionsPlay, because again, for those who are joining us a little bit late or don't know, Tony is one of the partners at OptionsPlay, and he is the chief strategist. So he's been actively involved with OptionsPlay for over a decade now. So if you have questions about it, he's the man to ask. So Tony, in OptionsPlay, how are strikes for long financed verticals selected?
So what we're doing when you think about a long finance vertical, which is also, you could call it what is the term that you use for that? The risk reversal?
Yeah.
Where you're selling a downside.
Yeah, if you're selling a downside put and buying an upside call, that's a risk reversal. If you're buying the put, the same strategy, if you're buying the put and selling the call, most people refer to that as a caller. So, I'm probably more likely to talk about things like call spread and put spread risk reversals because I tend to like to, buy a little bit of at the money premium and then sell some wings against it, sell some strangles, for example.
Yeah.
But, yeah.
And I know that a lot of traders like to trade, a risk reversal like this for basically either a net zero or net zero credit or debit, right? Or very close to it if possible. And in order to do so, usually you're selling a slightly out of the money put option, buying a slightly out of the money call option, and then selling roughly a call option. I'm sorry, I said selling a slightly out of the money put option, buying a slightly out of the money call option, and then selling call it a one standard deviation call option against all of that to offset the cost. And largely when you do that, you can try to trade that for a net credit or net zero debit on that particular trade. That's largely how we want to think about kind of a risk reversal, in my opinion.
Yeah. So I have I just used the default. So again, just taking a look at Lulu. All I did, in case anybody's watching, I'm just going to do this one more time so that you guys can just see me do it. All I did was just go in here and then select. So when you can choose a strategy, I just selected long finance vertical, and this is what it defaulted to. Now, important point. If you guys happen to use OptionsPlay, and I believe we have a coupon code for that for those who are interested in signing up for it, you can configure some of these settings, right? So you can configure some preferences, and so this is how these are set up in this particular case. But as you can see, you're collecting a little bit of premium on a standstill basis. So that's going to cover your transaction costs probably, and then some. Potentially put the stock down around, what was the default strike? It was the 230. So very close to the level that Tony had referenced earlier, which was those April lows, which was in the 230s. And then, we're getting long the 270, 280 call spread. I personally, as I just mentioned, I often will go probably a little closer to at the money with my call spread, but that's usually because I'm looking for a little bit more delta on mine. And then I'm actually not that concerned about whether I collect premium, I have to say, on a standstill basis right then, because oftentimes the wings will decay at an accelerated rate. So even if you're paying a slightly net debit, that doesn't mean that you are what we call short theta. That doesn't necessarily mean that the decay of that package is a negative one over time. And that's particularly true if you're doing trades like this going into an identifiable catalyst, because what happens when a catalyst comes and then goes? Vol crush. And when the vol crush happens, you short more options than you're long. So that can be a little bit of an offset too, but yes, I like that. So FinWest says, for once, your guest is closer to my time zone in Thailand versus yours in California. Well, yes, that's true. He's I don't know how close your time zones are, but I imagine they're not that far off.
I'm always amazed at the people that sign in from around the world for these shows at all kinds of hours. But thank you so much for joining us from Thailand.
Yeah, he's FinWest is a regular viewer, so we're happy to have you back. FinWest, if my recollection serves me correctly, was also an options market maker for a time. So Mike says, how does MicroStrategy pyramid structure? Talking about the preferred bonds, converts, strife, strike, all the rest of it, play into Tony's bond weakness scenario, given STRD is a new junk bond at 10% fixed. Do you have any thoughts on that? Your bond weakness. So it's interesting. I don't think you said that we were going to have a bad bond auction. You're just keeping your eyes open, thinking that it's a possibility because the last one was weak, right?
Yeah, well, and keep in mind that we had a relatively softer bond auction on the last time we came around, but also we saw that in Japan as well, right? We saw that 40-year bond auction in Japan come in much softer. The bid to cover ratio on that was like 2, I think, which is very low for those longer dated bonds for Japan, right? And I think that is kind of what investors should be paying attention to, right? It's not just here in the US, but also globally. And Japan specifically, I think, has quite a bit of sort of contagion risk, if you will, into kind of US bond auctions. And I think that is what just overall bond auctions typically is just not something that equity investors ever look at. But I think this is something that we need to start paying attention to. And Jamie Dimon was pretty vocal about this a couple of weeks ago, right? When he was referring to the quote unquote, we're likely going to start seeing cracks in the bond market. This is what he's referring to, is kind of the softness that we've seen in these auctions, the longer dated auctions. So from my perspective, that's really what I'm saying. We need to be paying attention to.
Yeah, I would agree. I mean, one of the things I think that we have to remember is that we live in a time of global markets. So if you have areas where we have had persistent and historically low rates, and we start to see that those rates rise and rise materially, that does pose a material risk elsewhere. This is one of the things that helped fuel for a long time the yen carry trade. It was about a year ago that people got very concerned about the yen carry trade coming unwound. The fact that you could borrow yen at virtually no interest rate, and as Japanese rates have risen, the attractiveness of that trade. And where does that money go? That money will then go into risk assets in higher yielding locations. That's sort of the idea is borrow money cheaply, deploy it where you can earn a higher rate of return. That's the whole idea if you can do it. When the cost of borrowing those funds starts to rise, or if the spread that you make starts to narrow, then it would also make sense that some of that trade would begin to get unwound. So it is important to focus on not just the U.S. bond auctions, as Tony mentions, pay attention to what's going on around the world. But do you think that if we continue to see weakness in global bond markets at the long end of the curve with respect to Bitcoin specifically, what are your thoughts there?
That's a really good question. I mean, you could argue that Bitcoin was created to offset some of this risk, right? And I think that overall, this would be supportive of kind of Bitcoin. It's overall supportive of Bitcoin, in my opinion. I mean, Bitcoin has its other challenges, but from a conceptual perspective, this would be a net positive for Bitcoin. It's tough, right? Because you look at stuff like the yen carry trade. The yen carry trade has a very high correlation with risk assets, right? So if you kind of see that yen carry trade unwind, you generally would expect risk assets overall to unwind along with that. And Bitcoin, is Bitcoin a risk asset or is it a safe haven? I think that it at times it plays risk assets, and sometimes it plays potentially as a short dollar, safe haven, if you will. So it's hard to say in my opinion. I don't know what your thoughts are there.
I would actually say both. So I think in the short term, if risk assets sell off, there tends to be a liquidation of almost everything. And that could, in the short term, include Bitcoin. But from a secular perspective, anything that demonstrates continued evidence that we should be concerned about fiat currency and about debts that are denominated in fiat currencies, and we continue to see them depreciate versus hard currency proxies, so whether that is precious metals or Bitcoin, I think that the longer term would be ultimately bullish. And then if you start to see that dynamic, the weakness that I think you would get, that knee-jerk reaction, people start to panic, correlations go to 1, they start selling. I think that if that is the driver of it, people should take advantage of that weakness in Bitcoin, which I expect would probably sell off, and buy it. That's my take. Okay, so somebody who is not on board. Actually, I'm going to talk about this restoration hardware trade, and then we're going to talk a little bit more about MicroStrategy and Bitcoin, because I see that we have Jim Chanos is mentioned there. But in your strangle swap models, like restoration hardware, July Sept, why skip shorting the week ending options with extremely high implied volatility and opt for shorting expirations a month out? those implied volatilities are high, but considerably less high. So that's an excellent point. I would just quickly point out that when I'm looking at these strangle swaps, so Tony wasn't here for this, but I'll just give a quick outline of what was going on there. Ahead of earnings in Restoration Hardware, I was talking about potentially trying to take advantage of the fact that implied volatilities were very high going into earnings. But I said you don't want to be naked short premium in this thing because it has just whipped around the last several earnings. The most recent one, in fact, I should have this up on for anybody who wasn't watching us before. This thing fell 40% when they reported most recently. And what's ticklish here, and the thing that I was pointing out, and the reason that I wanted to own some longer dated premium, is because this is a company that has significantly increased the amount of net debt that they carry. And that is because they have increased the amount of total debt they have by about $500 million, but then they also spent about $2.25 billion on stock buybacks over the past several years. They have about $1 billion, I think, remaining on the existing authorization, but they're not going to use it because they only have about $30 million in cash on the balance sheet, and they had almost $70 million in negative free cash flow in the most recently reported quarter. And so this means that the equity is now quite levered, right? So when you have that situation, you can get into a situation where the equity can really whip around, and that was the reason I was looking at those strangle swaps. So I think what Steve is asking about is why are you looking out here, for example, or here, rather than at the very shortest, dated weekly options? And the reason is this. It's true that implied vol space on a weekly option, it can be very, very high, but these are options that only have days to go after they report. So it's really a function of two things. If I had an option that expires at the end of the day, the implied volatility can go to infinity if that option has any extrinsic value, but that doesn't necessarily mean that I'm collecting huge amounts of money as a percentage of the current stock price. So that's the balance you're really trying to strike, right? Should you look to sell overpriced implied vol? Sure. But I also think that it's important to remember that in some cases, the dollar prices of these options are something else you need as a function of the price of the stock. Tony, what are your thoughts on that?
Yeah, you're referring to the June expiration as opposed to the June 13th expiration, right? That's trading at.
Well, I think he was actually talking about. He's probably looking at the June 13th as well because the implied volatility of that is 200.
Yeah, that's what I mean. He's saying, why are you skipping that June 13th expiration and looking at the Junes or the June 27th, right? And just to kind of put that into context, the 256% implied vol on that June 13th is obviously elevated. But, if you look at the June monthly expiration, you're talking about 135% implied volatility, right? And you look at historical, that's still well above historical implied volatilities. So, I still think you have a very strong mean reversion trade on selling premium or being short vol in that June expiration, right? That's going to
even out to July, which is close to 90.
Yeah, exactly. Looking at looking at the history of this, I'm just trying to look at this real quick. Even the July expirations, you're seeing extremely elevated implied volatility. So you have to put this into the context of historical volatility as well. And, outside of that 40% move, the June and July expirations are well ahead of, what historical volatility has been. So I think you have a strong mean reversion trade there. Potentially July is 87% implied vol right now.
At the money I see it is 91.5.
Right. And it's interesting, the implied move right now on Restoration Hardware is 14.5%, which is actually a little lower than the previous one. We're heading into the previous one, we're around 14.8%, when the stock dropped 40%. But stocks like this, this is really where I do think that investors are concerned, especially after you saw Deckers, you saw Lululemon, you saw all of these consumer discretionary names, especially on the higher end of the income curve. These are the ones that got hit the hardest. I think investors are scared that you're going to get a big move to the downside here in Restoration Hardware. They've obviously bid up, options premiums heading into that earnings announcement. And this is a classic example where you might believe that the stock's going to make a big move to the downside, but still buying puts may not be the right move here based on how expensive puts are.
One thing that has occurred to me is that, when we had a lot of consumer weakness early, some of the hardest hit stocks were those that cater to lower level consumers. So, the Dollar Tree, Dollar General stores. And of course, they were taking it from all sides. The people just have less money in their pockets. They were being pressured by inflation and lower transfer payments, cash balances. Everything was working against them. And so the consumer discretionary trade, most at the time were advocating you should go towards, the luxury goods, because luxury goods those sales were actually holding up really well. Restoration Hardware, I think, is it aspirational luxury versus luxury? I mean, it's not Ferragamo or Zegna or something like that, but it is. In theory, this is serving a demographic that isn't going to be that impacted. But what's curious to me, and this sort of just occurred to me actually, is that the same case has been made about American Express, that American Express serves a more affluent demographic and that they face lower credit risk. 100% agree with that. But I will say this, their fees are based also on consumer discretionary spending. So one of the things that I would say is that this one actually is not far off of their highs, and yet a lot of the consumer discretionary names where American Express card holders are supposedly spending their money are getting weak, like we were just talking about. And so I wonder, it's kind of interesting. What do you think about a potential pairs trade here where you might say, I'm going to pick up some of these consumer discretionary names that are really hard hit, that are trading below their historical multiples, and maybe, put on a little bit of a hedge trade by, selling some upside in American Express or something like that.
Interesting pairs trade. I've never even thought of something like that, but that actually makes quite a bit of sense. American Express, it's not that expensive overall. I don't love the stock. I don't hate the stock. It's trading at 20 times forward earnings. Which is above its own average. Yeah,
as we can see here on the screen.
Yeah.
I don't know if it's showing here. I'm going to make sure there. I need to highlight that line because I realized it was kind of faint for those of you who are trying to look at it. But now you can see that white bar. That's where we are now, and you can see that if we go back 10 years, are we at the highest we've been? So you should throw out the whole pandemic period because that's throwaway data, right? So we're dealing with multiples that didn't really make much sense because in many cases earnings went to zero or whatever. So exclude that from your calculus as you kind of think about it. But we are, we're at the upper end of the 10-year range in American Express. And again, if you're buying Lulu at 16 times and selling American Express at 20, it's thought. Like I said, it only occurred to me as we were talking about it. I hadn't really thought about that until just now, so I'll take a little bit more of a look at it. That's one of the things about doing a live stream, right? You get stream of consciousness. This it could be a good idea, it could be a bad idea. It's just an idea. It popped into my head. There you go. All right, so Jim Chanos shorts MicroStrategy, long Bitcoin. Makes sense if the MicroStrategy NAV at 2.2. Jim expects MicroStrategy Bitcoin balance sheet to further drop to at 1.8 to one to one, I doubt that MicroStrategy is going to trade 1-to-1 to its net asset value. I don't really see that happening. And the reason I don't see that happening is because there is some accretive impact to, at least for the time being, while volatility in Bitcoin is high and in MicroStrategy is high, there is an accretive impact. So they are able to sell upside vol in MicroStrategy to finance the purchase of incremental Bitcoin. So it shouldn't trade exactly to its book value per se. However, the skew should be different. So IBIT's skew should be steeper, in my view, than MicroStrategy if they continue to finance this way. And the reason is because MicroStrategy shareholders get the accretive benefit of that upside vol sale. That is to say that the book value of MicroStrategy will increase, but some of the upside's being sold away by definition. So what you should see is a little bit of a divergence in upside call premiums, which should typically be higher in MicroStrategy because it's levered. So more leverage, just like we were looking at Restoration Hardware. You add leverage, you add volatility to the equity. But if you sell off the upside, then it's going to behave more like a covered call strategy on the underlying Bitcoin. So they're slightly different assets. I'm not sure I'm totally on board with. I mean, I do think it's a pretty meaningful premium, but I don't know that it shouldn't trade down to 1-to-1 in my view. What are your thoughts, Tony?
Yeah, I agree with the fact that I don't think it should trade at 1-to-1. I don't particularly have a strong view on this. I'm not a huge follower of MicroStrategy in terms of why people trade such a big. I mean, it's obvious why people trade such a high premium, for this particular name relative to NAV. But I do think that there is room for that to come in a little bit. But I don't think I agree. It should not trade back to NAV.
Yeah, I mean, the important thing to think about when you're looking at MicroStrategy's valuation is that obviously you have the book value of the assets that any business holds, and that's going to be partially a driver. The other part of a business's valuation is going to be whatever they're able to do with that book value effectively. And in their case, it's a little bit of a financial engineering scheme, let's be honest. Volatility is high in the underlying asset. They recognize that they can capitalize on that by selling some of that and using that to purchase more of the underlying asset. So that's the net accretive effect. And they're not identical assets. But I have also said to folks that if you're sophisticated enough to trade options and you're sophisticated enough to be trading Bitcoin, are you not also able to find ways to do this yourself? And the short version of that is yes, because there's a lot of skew. So, you could do things like, have ratio call spreads or even just straight ratio call spreads. Let me just show you what the skew in the best way is to look at actually IBIT because you have a nice liquid options market. But, this is what I'm talking about here. These upside calls are trading at a material premium to the at-the-money ones. And so, you can, the risk-reward relationship of having things like call spreads in IBIT or call spread risk reversals is much more attractive than it is in most equities because generally speaking, if you looked at SPX, for example, this is just a downward sloping line. So you're going to pay 30-40% for the distance between the strikes to get an upside call spread in SPX. And here you're going to be paying a much smaller amount. And then you can sell it further out of the money put. And there's a lot of put skew in this as well. So there is that. Okay, so we talked about Michael Anthony. I do see you here, but we've talked about Pfizer and we have talked about Albertsons. And we talked about it actually on the last one. As I pointed out, I had previously recommended Kroger back when it was trading 10.5 times. It's now trading closer to 15. Certainly, I don't want to see everybody racing out to buy Walmart at close to 40 times forward if you're looking for a grocery store. So Albertson at 10 times I think is fine. But I don't think we need to get into it too far because that's not a hugely volatile and super exciting stock, but it's a fine place to be, decent yield and all that. Finwest says, agree on the 45-day time frame, but disagree on the deltas. I enter short puts at a 10 delta or less and covered calls in the money with a delta. Well, that's interesting. He sells covered calls that are in the money with a delta of over 60. So synthetic. So what you like to do then, Finwest, is sell puts. That's essentially what you're doing. Because if you buy stock and you sell an in-the-money call, you're essentially that's functionally equivalent to selling an out-of-the-money put. You sell a 60 delta call, you're selling a 40 delta put against stock. You're selling a 40 delta put. Interesting, And that's fine, because actually selling puts, you can generate premium that way. There's nothing wrong with that. But I think that's interesting, More than one way to skin a cat, I guess. I would simply say this in response to that, which is that, and I've said this before, I think it would be different if I was dealing with an underlying asset where I was indifferent to the price, fully agnostic to the price. I think the tasty trade guys are oftentimes, Tom Sosnoff, I've seen you talk to him more often than I do, and I've seen some of your videos that you've done with him. He's a believer in efficient market hypothesis, and if you are, then you're going to assume that the underlying asset is probably fairly valued and that you don't necessarily have unique insights. And if that's true, then premium collection is really what it's all about. People who watch me know that, rightly or wrongly, I do develop opinions about the value of the underlying assets. And if I choose a stock and I buy it, or if I sell puts in it, it's because I am comfortable owning it, as Tony said. And if I'm comfortable owning it, it's because I think it's undervalued. And if I think it's undervalued, then I want some of that value realization when it goes back to what I think it's worth. So again, I think this has more to do with one's opinion on the underlying asset. You can sell premium without a view on the underlying asset and make money. But if you do have a view on the underlying asset, give yourself room for your chosen direction. You think it's overvalued? Give yourself room to the downside. You think it's undervalued? Give yourself room to the upside. Tony?
Yeah. I mean, look, I think Finwest, we're actually saying the same thing in many ways. We're actually agreeing in a lot of things, right? Because if you're buying stock and selling an in-the-money call at 60 deltas, then that's similar to selling that's a synthetic short delta, a short put at roughly, call it 40 deltas, right? So, as I said, I prefer selling 40 delta short puts. The reason I prefer selling short puts versus buying the stock and selling an in-the-money call option is because, one, it's just an easier transaction, right? To make one transaction versus two. You also don't have to, if you're just selling a put option, you can do it on margin, which is more capital efficient than owning this, potentially more capital efficient than owning the stock and selling that 60 delta call. So I just think from an ease of transaction perspective, selling that 40 delta put is just a little easier than having to buy the stock and sell that in the money call option. And then, but as far as selling the less than 10 delta puts, that part I'm curious as to why, because you're putting on significant amount of margin in order to do that for very little yield. And I'm curious as to why you would choose to sell a 10 delta put when you clearly prefer to sell a 40 delta put. Like why do both? But
yeah, that's an interesting one. Let's just take let's just take a look at a concrete example. I think for everybody who's saying, you guys keep throwing all this delta stuff around, and what are we talking about here? So let me just make this a little bit more concrete, and let's just assume that we're going to sell. And he said 45 day. Let me just double check. I want to make sure I have the.
Yeah, he said 45.
45 day. Okay, yeah. 45 days. So here's a 44-day option, July 25th weeklies. So what would the 10 delta put look like? We don't have one that's exactly 10 deltas, but yeah, we're going to look at, say, now you're going to sell the 220 puts. These are actually more than 10 delta. Okay, those are 12 delta, but that's the 220 puts, and the mid-market price on those is $2. All right, round numbers. So we'll call it $2 over 220. So 220 is the strike, so that's really your risk. Your risk isn't the current stock price. So when you're thinking about yield, I like to, in a situation like this, I like to think about it on the put side. Usually I just divide by the strike. So we'll call it, we'll round up. We'll call it $2, and we'll give you the benefit of the doubt. So you could, you work the order, you get 210 over 220. So that means you're getting about 95 basis points over the course of 44 days. which works out to a little bit less than 8% annualized. I will say that, I like to see annualized yields of 12% or better on put sales if I can get them. One of the reasons I've mentioned this before, and I'll be curious to hear your thoughts on this, Tony. My rationale for that is this. You're taking an equity-like risk. Mm-hmm. And if you take an equity-like risk, you want an equity-like rate of return. Equities have traditionally returned, the long-term history, going back a century, was closer to 7 or 8%, but more recently, it's been double digits. So I'd like to see 1% a month, 12% annualized, to compensate me for taking an equity-like risk. What are your thoughts there?
Yeah, absolutely. And usually if you choose a higher delta, obviously you're taking on a little bit more risk, but you are seeing substantially higher annualized yields, well into the 20-30%, especially on a stock like Lululemon, you could easily get into that 20-30% yield taking a higher delta strike price. So I agree. I think 9%, that's what I was saying at the top, was that I feel like that's not enough yield to offset kind of the risk that you're taking here, in my opinion. Yeah.
There's a trade-off. I mean, you have a higher probability of profit, right?
Yeah.
A much higher probability of profit. So that's an important point, and that's the balance. I think everybody's gonna have a slightly different view on this, which is, where is your risk-reward balance point found? In Finwest's case, Finwest is saying, I want to sell puts where I have a very low probability of taking assignment, in exchange for which I'm collecting, in this case, 7 to 8% annualized. But he's going to get away with selling those puts 90% of the time. Yep. 9 out of 10 of those trades is going to be a winner. And so, everybody's going to, take a slightly different approach. I'm at the view, and I think you were espousing the view, that Lulu around 230, 235-ish, 240, you're getting to a level where the valuation seems reasonable. We don't mind being put the stock. We've already said that. I mean, I was actually just looking at buying the stock here and then trying to figure out what I was going to do next. I was dilly-dallying and talking about this one in Deckers with one of my former colleagues before the close, so I didn't really get time to act. But so there is that balance point, and then there's also your underlying view. A large part of the reason I do covered calls in the money is I wish to collect the dividend from the stock, and I have some downside cushion. Okay, definitely true that you have a downside cushion. The flip side, I would say, is that for anybody who's playing along at home, and Finwest, I know you had a background in market making. If you are short in the money call options in a stock that pays a dividend, and the extrinsic value of that option is less than the net present value of the dividend prior to the ex-dividend date, you should anticipate assignment. So that's one quick point I would say, right? So you may want to consider, if you're looking to make sure that you collect the dividends, compare the extrinsic value of those in-the-money call options. So you take the intrinsic value, that's the difference between the stock price and the strike price. You deduct that from the call price. If what's left over, that's the extrinsic premium. If that number is smaller than the net present value of the dividend prior to an X date, that call is probably going to get assigned. Another way you can be reasonably sure this is true is that if there's decent open interest on that strike and you see a lot of volume trading before a stock goes ex-div, a lot of volume in an in-the-money option, expect assignment. That's market makers trading back and forth with each other, and they're trying to scalp that volume. So, I don't disagree with what Finwest's doing here, but we're getting a little bit into the deeper end of the pool. So for those of you who are less familiar, maybe stick to the out-of-the-money option so you don't have to contend as much with the exercise and assignment issues. It might be a little bit simpler. Okay, so Farhead says, I agree, and then said, learn from the best, Tony. So he appreciates your input, as do I. Michael Anthony had said, do you think Albertsons is undervalued and should be higher in share price? I think it's reasonably valued at 10 or 11 times because their top line is not growing as fast as the economy, and they're in a margin compressed business, and they're competing with the likes of Walmart, which is overpriced. I agree with Tony. I think Walmart's overpriced, but that doesn't help Albertsons, right? They don't win because of where Walmart's stock price is. Their challenge is that they're competing against Walmart, and Walmart operates a very good and effective business. So those are two separate issues. Is Walmart's stock reasonably priced, and how good an operator are they? They are a very good operator. I wouldn't really relish competing against Walmart. I'm willing to invest in Albertsons at 10 times. Am I super excited about it? I'm not super excited about it because I have to fight against Walmart. And that's, that is the 800-pound gorilla in groceries globally, full stop. So we have that. FinWest says, exactly, I have to check the ex-div dates on all my positions every day. I got surprised a few times. Yeah, I mean, this will happen, and I encourage everybody who's doing this, pay attention to these types of things. If you are short in the money options, or if you are short options right before they're going to expire, always pay really close attention to what the stock's doing, because I've seen that too. I've seen assignments where stocks were out of the money, no one's paying attention, thing guns at the last minute, or it trades higher after hours, like Netflix did after earnings most recently. They had earnings on a Thursday right before Good Friday, and that turned out to be regular way expiration because it fell onto a Thursday instead of Friday because of the holiday. And there were a lot of people who got assigned, I'll bet, because they weren't paying close attention. All right, so with that, we have chewed up the full hour that Open Mic usually takes. And I really, really want to thank Tony for getting up so early in the morning in lovely Melbourne, Australia to join us today. And your insights, as always, are greatly appreciated. It's been too long because, Tony and I used to do Options Action all the time. And I always enjoyed his insights then, enjoy them now. Just don't get to hear him as often. Maybe we'll get him back here again real soon.
Thank you so much for having me. Looking forward to be back.
Looking forward to that too. All right, everybody. Thank you very much for watching. We'll see you next time.